Hello. Today we are going to go through the information on monetary policy and the Federal Reserve. Chapter 16.1 and 16.2 was for your reading that was due today. And as you can see on the screen, these are our target objectives for today. First of all, we're going to describe the structure of the Federal Reserve. I'm going to show you that in a few minutes. We're going to also explain the major regulatory responsibilities of the Fed. And then, probably the most difficult part will be you'll have to do an analysis and manipulate the tools of the Fed that they use to conduct monetary policy. And if you remember, we talked a little bit about monetary policy in previous chapters, or units, so hopefully this won't be too new to you as we go through it. Now to start, we're going to look at, and if my face goes away, I apologize, but we're going to look at, first of all, the definition of monetary policy. As you have your blank sheet in front of you, you can fill this in as you go, or highlight it if it's already there. The expansion and or contraction of the money supply in order to influence the cost and availability of credit. So the Fed, in its infinite wisdom, tries to manipulate the money supply through some of the tools that I had mentioned we're going to talk about in a little bit, which affects people's ability to gain access to money or not. And if you remember in previous information from earlier units, there were a couple policies we talked about. We talked about tight monetary policy and loose monetary policy. Tight monetary policy is basically where the Fed tries to restrict the amount of money that is going to be in supply. And again, we're going to get into much more detail about that in a little bit, but that is typically manipulated through interest rates. And if it's tight, that means interest rates will probably be higher. And again, we'll come back to that later. Loose monetary policy, on the other hand, would be the opposite, where interest rates would be lowered to allow access to more credit for individuals. Now, before we get too far into what the Fed does, I'd like to look at the structure of the Fed. It's our first learning target. So if you could go to the last page and fill in some information on these boxes for me, it'd be greatly appreciated. We're going to start with this structure of the Fed through its advisory councils. Now, this isn't the most important part of the Fed, but I thought I'd start with this just since it's at the top. The first one is the Federal Advisory Council, made up of member banks, banks that have basically bought shares into the Fed. They're national banks like Wells Fargo, Chase, PNC. Those are national banks that advise at a federal level. You got consumer advisory councils that make up the retail sector or the business sector of the economy that try to give the Fed advice on what's happening there. And then we have the Thrift Institute Advisory Council. That's made up of not banks. They're not banks. They're like service cooperatives, like credit unions, mutual savings banks. But typically we tend to think of a credit union as a thrift institution or a service cooperative like we learned in an earlier unit. It is not technically a bank. Now, going to the next part, this is probably the most important part of the Fed, or most part in the structure, is the Board of Governors. Now, the Board of Governors is made up of 7 members, and they are appointed by the President and confirmed by the Senate for 14-year terms. Now, what's interesting is, my question would be, why would it be 14-year terms? Well, the answer is so they're not influenced by politics. Theoretically, they're not influenced by politics because they're nonpartisan. So the idea is when they set policy, they don't have to worry about who's in office. And as you know, we talked about lag a week ago, where whenever policy occurs, sometimes there's a lag in between when it actually, you can see change in the economy because of it. But anyway, as you can see, I'll go down a little further, they set the discount rate, which we're going to talk about later. Another big part is the actual 12 reserve federal banks. And each of those banks has 9 directors that are appointed by the president of the Federal Reserve Bank. I would now like to show you what those banks look like in the United States on a map. As you can see, the United States is divided up into these 12 districts. Our district is 7 right here. And what's interesting, if you look at your currency, like here's a dollar, and you can see the letter L on it here where my finger is. That L represents a particular region. In this case, it says the Federal Reserve Bank of San Francisco, California. If you go A1, that's Boston, B2, you got New York, and so on. We're G7. And then obviously this bill then was ordered by the Federal Reserve Bank district in San Francisco, California. So this proves circulation is taking place because a bill that originated in San Francisco ended up in my hands in Fort Wayne, Indiana, and we're in District 7. So anyway, going back to our information, those are the 12 Federal Reserve banks, and they set the discount window and discount rate. And if you remember, well, we'll talk about that a little bit more about how that rate is set. Now, another very important part of the Federal Reserve System is the Federal Open Market Committee. They're made up with the 12 Board of Governors right here, so there's 7 of those, plus 5 of the 12 Federal Reserve Bank presidents, and they rotate that basis. They direct open market operations, meaning, and again, I will explain this a little bit later, they buy and sell government securities, which are, like bonds and treasury bills and notes, to influence the ability to get money in the money supply. Anyway, there are roughly about 5,400 commercial member banks. Those again are the national banks. Other banks that are state banks can choose to be a part also, but all national banks like PNC, Wells Fargo, they have to be part of the Federal Reserve. So let's go back to the front now again. What I need to talk about now is what are some of the rates the Fed manipulates that influence the availability of credit or money in the system. The first one is called the discount rate, or right next to that, the discount window. Just write the part I'm highlighting, don't write all of it. This is the interest rate at which financial institutions that are members, that we just talked about, of the Federal Reserve may borrow on a short-term basis. Typically, if you look here, banks borrow from the Fed at the discount window as a last resort. So this might be, for instance, an emergency. Let's say there's a hurricane in Miami, Florida. Miami is the district bank in that region. And if there's a hurricane, knocks out all the power, people need cash, but the banks in that area are low on cash. The local banks may borrow from the Federal Reserve to cover expenses at that point. But anyway, that's member banks borrowing from the Fed. That's the discount rate. Now the next rate is actually not set by the Fed. It is influenced by the Federal Reserve, but it's called the prime rate. And again, just write down the highlighted area. This is the common benchmark for consumer and business loans set by banks. It's kind of like the average, if you will, rate that banks charge pretty much all over the country. They don't have to charge that, but a lot of banks choose that rate to offer their customers at that time. It's usually at a level 3 percentage points higher than the Fed funds rate. And you're probably asking, well, what's the Fed funds rate? And that's what we're going to go over here in a minute. So again, prime rate for general loans for consumers and businesses. The discount rate is member banks borrowing from the Fed. And then the Fed funds rate, and again, don't write all this down, is the interest rate that depository institutions lend money to each other. So in other words, usually on an overnight basis, let's say Chase is low on currency, they borrow from PNC. And there's a rate that the Fed sets that the banks can borrow from each other. So, you know, it's like, would you rather borrow from a friend or a stranger? Well, banks like to do business with other banks because they probably will be a little more kind. Anyhow, what I'd like to do now is show you that current rate for these. And if you look, these are the current rates right now for all three of those rates. And the Wall Street Journal prime rate set is 3.25. So a lot of banks throughout the country will charge around that rate for consumer and business loans. The federal discount rate, if you remember, that's the rate between member banks and the Fed, is 0.75%. And the Fed funds rate is 0.25. And as we said earlier, it's usually the prime rate is about 3 percentage points higher than the Fed funds rate. Now, my question to you is this. If the Fed funds rate is set this low and the discount rate is this low, obviously, isn't the Fed trying to encourage the circulation of currency? In other words, a loose monetary policy. I hope that makes sense from what we talked about earlier. Now, let's go back to the other page now. We're going to flip the page, go to the back of the front, and what we're going to look at now are tools of monetary policy. Now, at this point, I don't know if you have enough information to help you understand how it's manipulated. So what I'm going to do, give you a minute to catch up on notes, and I'll start this part 2 in another video. So you can, when you're done catching up with the front, we'll go ahead and start the next video. We'll see you soon.